Have you seen the price of silver lately? It's gone absolutely ballistic, blasting past $84 per ounce for the first time ever, and then dipping to an intraday low of around $74 per ounce. We'll get into why the price dipped later in this video. And guess who's sounding the alarm? None other than Elon Musk. He's warning manufacturers that this silver squeeze is not just a temporary blip. It's a serious problem, and he's right to be concerned. This isn't just about investors piling in. This is a fundamental supply and demand crisis brewing right before our eyes. So, what's causing this unprecedented surge? It boils down to one simple fact. We are using way more silver than we can dig out of the ground. The demand is coming from every direction, especially from the green energy and tech sectors. Think about it. Solar panels, which are being installed at a record pace worldwide, are one of the biggest consumers of silver. Each panel needs it to conduct electricity efficiently. Then, you have the electric vehicle revolution. EVs use significantly more silver than traditional gasoline cars, not just in their batteries, but in all the complex electronics that make them run. And it doesn't stop there. Our modern world is built on silver. Every smartphone, every laptop, every single electronic device you own contains a small amount of it. Now, add another massive consumer into the mix, AI data centers. These gigantic server farms are the backbone of the artificial intelligence boom, and they require vast amounts of high-tech components, all of which need silver for its superior conductivity. This explosive multi-front demand is creating a perfect storm. The problem is, the supply side just can't keep up. Unlike gold, silver isn't typically mined on its own. Over 70% of the world's silver supply is a byproduct of mining for other metals like copper, lead, and zinc. This means miners can't just decide to ramp up silver production overnight. They'd have to mine enormous amounts of other metals to get a little extra silver, which isn't always economically viable. So even with skyrocketing prices, the supply response is sluggish and limited. This imbalance has been going on for years, leading to a structural deficit. We've been drawing down global stockpiles to fill the gap, but those reserves are now hitting critically low levels. Think of it like a global savings account that's been consistently overdrawn. The vaults in major trading hubs like London and New York, which are supposed to buffer the market, are seeing their inventories shrink at an alarming rate. There just isn't a lot of physical silver left to go around. And just when you thought things couldn't get any tighter, geopolitics enters the picture. China, a major player in the global supply chain for many critical materials, has recently implemented new export controls. Now, these require exporters to obtain government licenses starting January 1st, 2026, with additional criteria like a minimum annual production capacity of 80 tons for eligibility. Countries are now starting to hoard their strategic resources. With China deciding to restrict silver exports to prioritize its own booming domestic industries, this could send a massive shockwave throughout the global market and tighten physical availability even further. This brings us back to Elon Musk's warning. As the CEO of Tesla, a company at the forefront of both the EV and solar energy sectors through its Solar City subsidiary, he has a front row seat to this crisis. When he warns other manufacturers about the spike, he's not just making a casual observation, he's seeing the direct impact on his supply chains and production costs. A key component for his cars and solar panels is suddenly becoming incredibly expensive and scarce. This isn't just a headache for Tesla, it's a potential roadblock for the entire green energy transition. If the cost of essential materials like silver keeps climbing, it makes everything from electric cars to solar power more expensive for everyone. The $84 per ounce price tag isn't the end of the story. It's likely just the beginning. We're talking about a fundamental repricing of a metal that is absolutely essential for our future. For decades, silver has been seen as gold's less glamorous cousin, primarily an investment asset. But now, its industrial identity is taking center stage. The market is waking up to the fact that silver is an indispensable commodity, and there simply isn't enough of it to meet the explosive demand from the industries that are shaping the 21st century. What does this mean for you? Well, if you're an investor, the dynamics are certainly compelling. But more broadly, it affects all of us. The price of electronics, the cost of clean energy, and the speed of technological advancement are all tied to the availability of this one precious metal. The days of cheap, abundant silver are over, the squeeze is on, and the ripple effects are just starting to be felt across the global economy. This isn't just another market fluctuation, it's a sign of a major shift, a resource crunch that will define the next decade. When a figure like Elon Musk, who is literally building the future, tells you to pay attention to a raw materials shortage, it's wise to listen. The Great Silver Crisis has begun, and its impact will be felt far beyond the trading floors. Now, let's get into why the price of silver suddenly dropped. If you've been watching the silver market, you just saw something wild. We saw a rocket ship launch to $84 an ounce, and then, just as fast, a catastrophic collapse all the way back down to $74. To anyone new to this market, this looks like the end of the world. It looks like the rally failed. The bubble just popped and the whole trade is completely over. The natural emotional reaction is fear, panic selling, and second-guessing everything you believed about silver. But if you're a veteran, you've seen this movie before. If you were around for the market fireworks in 1980 or the roller coaster ride of 2011, you recognize this pattern instantly. This wasn't a fundamental breakdown in silver's story. This wasn't organic selling from long-term holders. This was a classic textbook stop hunt. So what exactly is a stop hunt? It's not some random market fluke. It's a calculated, often algorithmic maneuver designed to do one thing: shake people out of their positions. Its goal is to flush out the overleveraged traders, force automatic selling, and ultimately transfer silver from what we call weak hands to strong hands. The primary targets are traders using insane leverage, like 10 times their capital, and anyone just trying to get rich quick without a real strategy. To understand how this works, you need to understand stop-loss orders. A stop-loss is an automatic sell order that an investor places. It's designed to protect them from big losses. It says, if the price drops to this specific level, sell my position immediately. Now, think about it. Most of the traders who jumped in and bought silver near that $80 peak probably placed their stop-loss orders somewhere around $75. This creates a massive visible pool of sell orders, a pool of liquidity sitting right there on the chart. And guess who knows exactly where those stops are? The big banks and major financial institutions. They have access to sophisticated databases, they can see the order flow, and they have all the positioning data. They know exactly where the pain point is. So how did they engineer the price crash? It's a multi-step process. First, near the highs, these large institutions started selling massive blocks of paper silver futures. This initial wave of selling was enough to push the price down just a little bit, but crucially, it pushed it low enough to trigger that first wave of stop-loss orders around $75. Once those first stops were hit, it created a domino effect. Those automatic sell orders triggered more selling, which pushed the price down even further. This triggered even more stop-loss orders below that level. At the same time, traders using leverage started getting margin calls from their brokers, forcing them to liquidate their positions to cover their losses. The result is a brutal cascade effect. A rapid, vertical drop in price that seems to come out of nowhere. It's not a gentle decline, it's a waterfall. But here's the most important part of the story. This is a rinse and repeat mechanism. Once all the forced selling from stop losses and margin calls is exhausted, and the panic sellers have all thrown in the towel, what happens next? The very same banks and institutions that initiated the selling at $83 and $84 step back into the market. They start buying back everything they sold, but now they're buying it at $74 and $75. This whole process is known in the industry as rinsing the leverage. It's brutal. Many would argue it's unfair. But believe it or not, it is perfectly legal and it is standard behavior in these markets. So why does this have to happen right before the next major move up? Because markets can't sustain a healthy trend when they are overloaded with excessive leverage and speculative gamblers. Strong trends don't just go straight up in a clean line. They need to breathe. Volatility is the mechanism the market uses to shake out those weak hands, to clear out the short-term speculators, and to reset the positioning, paving the way for a more sustainable continuation of the trend. Think about how charts actually behave. Price never moves in a straight line. Healthy bull markets always have a pattern. They surge, they pull back, they consolidate and build a new base, and then they resume their move higher. These violent pullbacks are especially common when the price approaches a big psychological number like $80. The effect is amplified 100 times over by all the leverage in the system. This really highlights the classic battle between smart money and dumb money. What does dumb money do? It buys strength. It chases those big green candles on the chart, gets excited, and piles in at the top. It often uses high leverage to magnify its bets. And then, at the first sign of a pullback, it panics and sells at a loss. What does smart money do? The complete opposite. Smart money buys weakness. It patiently waits for moments of fear and panic like this one to accumulate positions. It uses patience, not leverage, as its primary tool. When you hear financial experts talk about a transfer of wealth, this is exactly what they mean. It is a transfer of assets from emotional, impatient traders to disciplined, patient capital. This volatility is a psychological trap, and it's designed to work against you. It's meant to make you doubt your own research and conviction. It's engineered to make you sell at the absolute worst possible time, right at the bottom of the dip. It makes you feel like you were wrong about the entire trade. The market is a master at exploiting our most basic human emotions: fear, greed, and impatience. So, what is the key takeaway from this whole episode? That drop from $84 down to $74 was not random. It wasn't an accident, and it certainly doesn't mean the silver bull market is over. What it was a positioning reset. It was a leverage flush. It was a textbook, perfectly executed stop hunt designed to prepare the market for its next major leg higher. Here's the final thought I want to leave you with. If you allow this kind of volatility to shake you out of a solid position, you simply become the liquidity for someone else to build their position. Price swings are not your real enemy in investing. Your own emotional reactions are. Understanding this dynamic is the key to surviving and thriving in these markets. Thanks for watching, and don't forget to hit that like button and subscribe to the Silver Thesis channel. Stay tuned for more insights, and remember to always do your own research. We'll see you on the next one.